Have you ever wondered why, no matter how hard you save, the global financial system always feels like it's teetering on the edge, threatening to erase years of your financial progress? For young investors starting out, the greatest financial insecurity isn't usually losing money on a single stock. It's the fear that some giant, invisible force will crash the entire market and steal your future. Well, that force exists, and it's a $600 trillion market that almost nobody understands, yet it underpins every single pension fund, major bank, and government bond on Earth. This market is derivatives. Think of them not as actual assets, but as bets. Bets on the price of literally everything from interest rates to currencies. As Warren Buffett famously warned in 2003, they are financial weapons of mass destruction. He was right. These weapons nearly destroyed the global economy in 2008. It was a mess. But here's the most terrifying hook. The system's response to that near-death experience wasn't to eliminate the weapons, it was to multiply them. Today, this market is 10 times larger than it was during the Lehman Brothers collapse. If you have insurance, a mortgage, or any investment tied to the traditional banking system, your wealth is currently standing on a structural weak point. So, how did a financial market that required a $29 trillion bailout just 15 years ago balloon into a $600 trillion behemoth, and why will there be no money left in the world to save it next time? To understand this financial time bomb, we have to start with the mechanism. What is a derivative, and why does it multiply risk? At its simplest, a derivative is a contract whose value is derived from an underlying asset. That underlying asset could be a stock, a bond, or a barrel of oil, but it could also be something abstract like an interest rate, a currency exchange rate, or even the likelihood of a company defaulting on its debt. The key curiosity hook is this. You don't have to own the underlying asset to bet on it. It's essentially a side bet, like buying an insurance policy on a house you don't own and hoping it burns down so you can collect. Wild, right? While derivatives can be used for genuine, low-risk hedging, like a farmer locking in a price for wheat before harvest, the vast majority of the $600 trillion market is dominated by banks using them to make leveraged, high-stakes wagers on interest rates and credit risk. And here is where the mechanism becomes dangerous for you. Leverage on leverage. The derivative's notional value, the face value of the bet, is often hundreds of times larger than the money actually put up. If a bank makes a $100 million bet, it might only put up $1 million in collateral. That's a 100 to 1 leverage ratio. This means a small, innocent market movement of just 1% moving against the bank can wipe out all its capital, and a 2% move means the bank instantly owes money it doesn't have. Seriously? Multiply this by thousands of complex contracts across every major institution, and you create a system where a failure at one bank cascades like a virus to every other bank it has traded with. A terrifying vulnerability known as counterparty risk. This incredible amplification of risk is why derivatives turned a simple housing problem in 2008 into a global financial meltdown. But today, the underlying assets for the biggest bets aren't toxic mortgages. They are the rising interest rates and the colossal amount of national debt. That sets the stage for the unthinkable scale we face today. Now we arrive at the most crucial data point, the one that suggests the next crisis will be different from 2008. The scale. In 2008, the world watched as major institutions imploded. The result was a near-total financial shutdown that required central banks and governments to commit an astonishing $29 trillion in bailouts and money printing. That was the price of a temporary fix for a derivatives market that was roughly $60 trillion. So, what happens today when the derivatives market has an estimated notional value of $600 trillion? That number is 6 times the size of the entire global economy. This is the simple mathematical truth behind the thumbnail text. Risk has increased by a factor of 10. Period. If only 5% of that market were to fail, A smaller failure rate than in 2008, the resulting losses would be $30 trillion, instantly wiping out the entire economy of a major nation. Here is the ultimate hook, the threat to your savings. Governments are already buried under historic debt. If central banks tried to print another $20 trillion to save the banks this time, it wouldn't be without consequences. It would trigger a severe inflationary crisis or significant currency devaluation, making your wages and dollar-denominated assets severely vulnerable. It would severely impact your financial stability. The paradox is that the banks have grown so large and so leveraged that saving them now poses an unacceptable risk to the purchasing power of the average person. This is the system's fatal, self-imposed trap. The only way to build financial resilience and secure your financial future is to own a portion of assets that are not directly controlled by the policies of the central banking system. Full stop. The threat is clear, but who is holding the fuse of this financial time bomb? This is the final layer of hidden risk. The derivatives market isn't spread out, it's terrifyingly concentrated. In the United States, roughly 90% of all derivative exposure is held by just 4 colossal institutions: J.P. Morgan Chase, Citibank, Bank of America, and Goldman Sachs. J.P. Morgan Chase alone has over $54 trillion in notional derivative exposure. That's roughly 180 times its total equity capital. This concentration means there is no diversification. If one bank fails, its counterparty risks instantly propagate, leading the others to follow. The system has become too big to fail, but also too big to save without severe consequences. That's the bottom line. This brings us to the ultimate question for your financial future. How do you secure your wealth when the system is structurally vulnerable? The key to resilience is strategic diversification into non-fiat assets. Here are the 3 essential steps you must take to build financial sovereignty today. 1. Reduce debt. The banks are leveraged, so you shouldn't be. Eliminate high-interest, non-productive debt like credit card balances. When the market is chaotic, being debt-free gives you the ultimate power, the ability to buy assets when others are forced to sell. 2. Mandatory diversification, redefined. Don't just diversify in the stock market. You need to diversify some portion of your assets outside the central banking system. Yes, keep dollar-cost averaging into broad, global index funds, but dedicate a sensible percentage of your portfolio to time-tested, non-fiat assets like physical gold or silver, and crucially, Bitcoin. These assets exist outside the $600 trillion web of derivative contracts and cannot be inflated away. 3. Invest in your income. Your ability to earn is the only asset that truly guarantees survival. Focus on skills that are recession-proof and technologically relevant. More income means more power to purchase resilient assets and take advantage of any coming market volatility. Understanding the $600 trillion risk isn't about panic. It's about informed preparation. It means you will be one of the few who is ready for increased market volatility. If this video exposed a truth you needed to hear, please hit subscribe to join the historical wealth community and comment below to tell us what financial topic we should expose next. Now, take control of your assets, focus on resilience, and secure your future today. Go get it.